$320 billion. That is the AI price tag big tech is paying this year, and your portfolio is on the line. Now, 30% of the S&P 500's profits are now tethered to this single fragile AI trend. If this gamble fails, the entire market gets repriced overnight. You are watching the greatest spending spree in history, and today we are going to break down the 4 fatal flaws in Microsoft, Amazon, Meta, and Tesla's AI strategy. You need this guide to survive. Welcome back to my channel, the place that tells you the truth when the headlines won't. I'm Grant, and I rebuilt my trading account after chasing blind hype. And I've learned the hard way, and now I'm breaking down what's actually happening in AI and how you can protect yourself. Here's the reality. No major tech company can afford to fall behind in AI. The race is full blown, and that creates a problem for smaller companies. Spend and risk margins, or don't spend and get left behind. That's how bubbles form, guys. Not from hype, from fear. Fear of falling behind. Now, before the deep dive, understand the core logic flaw. The cost of AI is exploding faster than efficiency gains, and for years, our growth was fueled by Moore's law. Now, AI training costs might only drop 10 to 20% every 2 years. This means every billion that big tech spends, they face diminishing returns. Adding to that, the energy crisis. Every new data center adds enormous non-linear costs for power and cooling. This unseen burn will hit the balance sheet hard. Let's deep dive into the 4 big tech cases: Microsoft, Amazon, Meta, and Tesla. Firstly, Microsoft is going harder than anyone. In fiscal 2025, the company plans to pour $80 billion into AI-enabled data centers, more than half of that on US soil. Now, in Q1 alone, they burned $20 billion in capex, with $14.9 billion going straight into infrastructure. What does it mean? Well, if Microsoft can turn AI infrastructure into sticky enterprise contracts, they win the decade. But here's the catch, and it's a big, big one. AI infrastructure is insanely expensive to build and to maintain. Energy, cooling, computer, and data movement costs are exploding. Now, if enterprise demand slows, Microsoft becomes overbuilt and over-leveraged. Next, Amazon, the most aggressive spender. In 2025, Amazon plans to spend $125 billion on capital expenditures, a 62% increase compared to last year. That single number makes Amazon the most aggressive spender in the entire AI arms race. Most of that is going straight into cloud and AI infrastructure. AWS is still the world's #1 cloud provider, and Amazon's strategy is simple: build more, sell more. Lock in enterprises before competitors do. But here's the part CNBC never ever talks about. AWS margins have been shrinking for years. Now, scaling infrastructure isn't linear. Servers grow fast, but depreciation grows faster. Energy costs explode. Amazon still doesn't have a clear AI revenue engine to justify this burn. Now, investors saw it instantly. The moment Amazon announced the spending spike, the stock dropped over 5%. Now, the real equation, high capex plus unclear AI revenue equals cash flow time bomb. Amazon isn't spending to profit, it's spending to survive. Amazon is betting the world will eat its AI buffet, but if demand lags, they're serving a $125 billion meal to an empty restaurant. Let's come to the highest risk player, Meta. Now, in 2025, Meta plans to spend $60 to $65 billion on capital expenditures, almost double pre-AI levels. Now, even Mark Zuckerberg's boldest move yet: I'd rather waste billions than lose the AI race. But Meta has a fatal weakness. It still depends almost entirely on ads. Now, ads are cyclical. AI infrastructure is not. That mismatch can turn Meta into a capex zombie fast. Massive server farms with no monetization to sustain them. Now, the danger analysts see that if user growth slows or advertising spending softens, or AI features fail to generate real revenue, well, Meta will be the first hyperscaler to crack. Now, unlike Microsoft or Amazon, Meta has no enterprise cloud and no diversified cash engines. Ads alone cannot fund a $60 billion AI gamble forever. Finally, Tesla, the wild card. In 2025, Tesla is dumping 10 to 15 billion into XAI and AI robotics. Elon Musk is all in: autonomous driving, humanoids, and future bets. Here's the reality. AI and robotics cost a fortune. Data centers, chips, robot prototypes, massive burn. Tesla's EV business is a cyclical cash flow, and it's not cash guaranteed. Now, Michael Burry calls Tesla ridiculously overvalued. Forwards earning multiple, 209 times, and dilution ongoing. Now, Tesla isn't just innovating, it's gambling billions. No enterprise cloud, no SaaS safety net, ads, none, just vision, high risk, high reward. Watch closely. So the big players are spending like mad to secure long-term survival, but there's a catch: investors are already jittery. Every AI spending surge, concentration risk is insane. AI stocks now make up 30% of the S&P 500's profits. If AI fails to deliver, the S&P 500 could be repriced overnight. Now, before chasing hype, ask one question. Where's the real cash flow? Not projections, not promises, cash flow. Now, right now, companies aren't just innovating, they're sitting on landmines. Now, if you want to survive this AI-driven market, watch the AI wave, but ride it smart. Focus on companies with sticky revenue streams and clear paths to profit, not just CapEx commitments. Now, hyperscalers like Microsoft, Amazon, and Alphabet, well, they'll likely lead, but don't ignore the smaller plays with real AI monetization, GPU makers, cloud infrastructure providers, software AI platforms. Know which companies have sticky revenue streams and clear paths to profit. The AI arms race is on. The money is flowing, but the risk, that's off the charts. Now, I'm Grant, a US stock market trader, and if you want signal without noise, subscribe, like, and stay tuned. Next, we'll break down which AI plays actually make money and which are traps. Don't get caught on the wrong side.